Could also mention, for example, buybacks. Yeah. Buybacks. Buyback is similar to a dividend. Dividend actually is paid out to share owners as cash. Buyback is more like the firm buys back the shares from share owners, but it also decreases equity. Yeah, you could also mention, for example, net loss. Yeah, would also be if a company makes a loss, the loss also the opposite of a profit, the opposite of income, could also decrease. Yeah, so this is a third possibility actually. Okay. Yeah, so dividend, buybacks, and net losses decrease equity. Share issuance and net income increase equity. Net income, of course, because the more profit a company makes, the higher is its equity. And share issuance also, if a company issues new shares, then this increases the share capital of the company. The beginning cash balance was 9,000 euro. At the end of the period, the balance was 11,000 euro. If total cash out during the period was 25,000, the amount of cash receipts was. Try that. Maybe first try to do this on your own. So let me put the account in. So this is the cash. The beginning balance. Beginning balance is 9,000. At the end of the period, the ending balance says is 11,000. So this is 11,000. That's the ending balance. Has to be on the debit side, yeah, because we have an asset account, cash. Total cash paid out during the period was 25,000. Paid out has to be here. So the question is really, what is this? What has to be here? And think about it again. We have 9,000 at the beginning. 25,000 leaves. And at the end, we should have 11,000. What do we have to add here? Think about it again. What makes sense? 25,000 goes out. How much has to go in? That at the end we have 11. And Liang is correct. It is 27. Yeah. Does that make sense? Do you understand why? We have 9,000 at the beginning. We should have 11,000 at the end. 25,000 is leaving. What does have to come in? It is 27,000. You understand? Okay. Then we can go on. In a double entry accounting system, half of all the accounts have a normal credit balance. Liabilities, owner's equity, and revenue accounts all have normal debit balances. A debit entry is recorded on the left side of a T account, or both A and C are correct. Which is the correct answer? Think about it. Think about it on your own first. C is correct, yeah? A debit entry is recorded on the left side of a T account. Very good, Chenray. Debit entry is recorded on the left-hand side of a T account. Half of all the accounts have a normal credit balance. No, that's not necessarily true. It could be true, but this is not necessarily true. Liabilities, owner's equity, and revenue accounts all have a normal debit balance. That's wrong. Why? Because they have credit balances. Yeah. Liabilities, credit, owner's equity, credit, revenues, also credit. Yeah. So, and both A and C is so C is correct. Yeah, C is the correct answer. Which accounts appear on which financial statement? Balance sheet, receivables, land and payables, income statements, revenue, supplies. Or balance sheet, cash, revenues, land, income statement, expenses, payable. C, a balance sheet, cash, receivables, payables, or income statement, revenues, expenses. Or D, balance sheet, expenses, payable, and cash, and income statement, revenues, receivables, land. Exactly, yeah. Liang and Chen Ray have it right. It's C. Balance sheet, cash is balance sheet, receivables is balance sheet, both are assets. Payables is also balance sheet. What is payables? Is it asset or liabilities? Liabilities, correct. Income statement is revenues and expenses. This is correct. Yeah, revenues and expenses both appear on the income statement. Yeah. Supplies, Chen Ray says supplies is not in the income statement. He's right. Yeah. Next one. A doctor purchases medical supplies of 760 and pays euros 380 with the remainder on account. The journal entry for this transaction would be which of the following? Have a look. What do we have to debit? What do we have to debit? And what do we have to credit? What is debit and what is credit? Which of the answers is correct? By the way, DR stands for debit. DR is debit. And CR is credit. Yeah, credit cash is correct, and you should debit supplies. Yeah, because debit supplies is an asset, and you debit it, it goes up, and you credit cash and credit accounts receivable. Yeah, so C is correct. Debit supplies because the doctor purchases the supplies. So supplies asset goes up, yeah, and the doctor pays cash 380, yeah, that's why cash is credited with the remainder on account. Yeah, the remainder is on account, that's why it's also credited. Yeah, so C is correct. Do all agree? Does it make sense? Yes, okay, so it's clear, C is correct. Then we go on with the next one. A debit entry to an account increases liabilities, increases assets, increases shareholders' equity, or both A and C. When you debit an asset, does it go up or does it go down? When you debit a liability, does it go up or does it go down? When you debit shareholders' equity, does it go up or does it go down? Exactly. B is correct. Liang? B is correct because only an asset is increased when you debit. Yeah, only the others, when you debit the others, when you debit liabilities, they go down. When you debit shareholders' equity, also goes down. Okay, good job, very good. Then next section is accrual accounting. And what does accrual accounting mean? What does accrual accounting mean? Accrual accounting is the opposite to cash accounting. Yeah, there's cash accounting and there's accrual accounting. cash accounting only shows cash transaction. Yeah. And in cash accounting, when we're talking about cash accounting, yeah, this is not accrual accounting, but when we are talking about cash accounting, then there are profits when cash inflows are larger than cash outflows. Yeah, so cash inflows have to be larger than cash outflows, then we have a profit. But the problem is, cash accounting is not allowed according to IFRS accounting rules. So, yeah, so not allowed. Yeah, there are exceptions, for example, for small businesses, but generally cash accounting is not allowed. Yeah. What is allowed is accrual accounting. Yeah, so accrual accounting is allowed. Cash accounting, according to IFRS, no, it's not allowed. Accrual accounting is, yes. And accrual accounting shows the impact of transactions on assets and liabilities in the periods in which the transactions occur. Yeah. So this means, for example, if BMW is selling a car, yeah, it can book revenue. Yeah, it can book revenue. Also, the customer has not yet sold. Yeah, even if there is no related cash flow, yeah, revenue can be booked. Yeah, so that's why you say it. We have receivables and payables. So, and essentially, you can book revenue whenever you hand over the product to the customer. This is the point in time when you can book the revenue, when you hand over the product, and not when the cash is coming. Yeah, not when the cash is coming. In cash accounting, you can only book revenue when cash is coming. Yeah, but in accrual accounting, you book revenue when you hand it over, and then you have an account payable, an account receivable. The other party has an account payable, and later you pay. So in accrual accounting, profit is not necessarily determined by cash in and cash outflows. You can have, for example, negative cash inflows, but nevertheless have a profit. Yeah. Instead, profit is not cash in minus cash outflows, but rather it is income minus expenses. Yeah, it is income minus expenses. And income is defined as increases of equity. Yeah, increases of equity, but excluding transaction with owners. Yeah, e.g., additional capital from share owners. Yeah, if you have a share issuance. Yeah, so this is share issuance. Then this is not income. Share issuance is not, that's not income. Expenses, on the other hand, is defined as decreases in equity. Excluding transactions with owners, dividends. Yeah, if you have a dividend is no expense. What other transactions with owners are thinkable? There's dividends, and what else can we think of? What is also a transaction with an owner? Dividends or buybacks. Yeah, buybacks. It's also a transaction with an owner. It's not an expense. Yeah, it's not an expense. But for example, if you pay rent, then this paying of rent is a decrease in equity and it's not a transaction with owners. Yeah, that's why it's an expense. That's why it's an expense. If BMW is selling its cars, yeah, then that is an increase of equity. Yeah, and it is not a transaction with share owners. Yeah. In accrual accounting, cash flow and profits are often not the same. And here are examples. Yeah, sometimes, for example, you have a profit, but part of the profits are used to pay for new assets. Then actually the cash flow is lower. The cash flow is lower than the profit because you need some of the money of the profit to pay for new assets. Then a firm has sold something but will collect cash later, results in an asset, accounts receivable. This is our example. BMW sells a car, but the customer is paying later. Then cash flow is actually lower. Yeah, cash flow is lower than our income. Yeah, our income. A firm has paid rent in advance. Yeah, it's a negative outflow, or it's an outflow rather. It's an outflow of cash. Yeah, but it is not an expense yet. It is a prepaid expense, and essentially a prepaid expense is not an expense, but rather it's an asset. A firm buys something on account. If a firm buys something on account, that results in a liability. It's an account payable. Yeah. If a firm buys something on account, it is not yet a cash outflow. If a firm has collected money in advance of providing service or selling the product, then this is a cash inflow. Yeah, but this cash inflow results in a liability. Yeah, it results in a liability to provide the service. That's a liability. Yeah, these are all examples where cash flow and profits, income, are not the same. Yeah, here you have deferred income. Yeah? You have gotten the money, the firm has gotten the money, but the firm has not provided the service. When the firm provides the service or sells its product, then the revenue is earned. So these are all examples of accrual accounting, and all firms have to use accrual accounting. Yeah. Because it better measures the performance than cash payments. Yeah, because it better measures the performance. We have in accrual accounting, we have the time period concept. What does that mean? That firms have to report at regular periods. Yeah, at regular periods. Mostly it's annually. Yeah, and when firms report annually, yeah, this reporting is called the annual report. Yeah, this is annual. Annual report. Sometimes it's more frequently, yeah, and then it's a requirement of, often it's a requirement of the stock exchange. Yeah, sometimes you have like maybe you've heard of this quarterly earnings. Quarterly earnings. We have the revenue recognition code concept, and revenue recognition concept basically means that revenue is recognized when it is earned. Yeah, and when is revenue is earned? This is not necessarily not when cash is coming. This is not the cash flow. But rather when risk and rewards, when they pass to the buyer, when the control changes. So that means, for example, in the example of a car, when you hand over, when the firm hands over the key to the customer, when revenue has to be able to be measured reliably, and it is probable that economic benefits flow to the firm, and the related costs can be measured reliably. Whenever that is met, yeah, whenever that is met, all this has to be true. Whenever this is met, then revenue can be recognized. Yeah, it's not necessary when cash is coming. Yeah, but when this is recognized, then the revenue can be recorded. Yeah, this is when risk and rewards pass to the buyer. When you hand over the car to the buyer, when the control changes, now it's in the control of the buyer, because the buyer can drive the car. Yeah, it has to be measured to be able to be measured reliably, and it's probable that economic benefits flow to the firm. Yeah, and related costs have to be able to be measured reliably. If all that is the case, then revenue can be recognized. Yeah. Okay. So that's it for today. Very good job. Very good job, all of you. So we have well participated in the lecture, and I hope in future lectures it will be as good as today. And our next lecture we have next Monday at 9 a.m. So German time. Yeah. So next Monday, but I write you an email again. See you. Bye bye.